This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
We're all kind of keeping a watch on GM today.
Yeah, shares are certainly revving up right now. This is the car maker sees higher profits ahead this year on improved sales, thanks largely to a belief that its biggest problems in 2023 are in the rearview mirror. I mean, that was a big deal with the strike last year.
Yeah, it was a lot of things, certainly, chipping away at them. So the automaker plans to reintroduce gas-electric hybrid models, which the company sells in other markets currently. They're also staying, though, very committed to ramping up production of battery-only vehicles. GM CEO Mary Barra remains committed to an all-electric vehicle lineup by 2035.
We're going to be building many more Ultium-based EVs. We had a constraint with modules. We have addressed that. We're on track for the first month, and by the middle of the year, that should be well behind us. So that's going to allow us to build many more of the existing vehicles, like the Cadillac Lyriq and the GMC Hummer EV, the Silverado EV work truck, etc.
That was GM CEO Mary Barra, who said once again that she remains committed to an all-electric vehicle lineup by 2035, but they are reintroducing gas-electric hybrid models. With more on GM, let's bring in our Detroit Bureau Chief, where we find Bloomberg News Detroit Bureau Chief David Welch, joining us on Zoom. David, good to have you back with us. Let's talk a little bit about the stock move today. I mean, what is it about the results specifically you think that are driving investors to send shares higher?
Financially speaking, they beat everywhere they could, right? So the fourth quarter was a bit better than expected, always a good thing to do. And for the year, they were as well. And then their guidance for 2024, also better than analysts were expecting. And then you look at what goes into that. There were three big things that really hurt profits last year. One was how much they spent on Cruise, which is their robotaxi company. They've grounded the fleet because of regulatory problems after an accident they had. Hitting a pedestrian in a crosswalk. So they're going to reduce spending on Cruise by $1 billion while still developing the technology. Investors place almost no value on autonomous vehicles right now, so if GM spends less, they like that. Another big item, $1.7 billion that hurt earnings because GM's making battery cells for its EVs, and they're doing so at low run rates that are not profitable at all. And because of some accounting rules, they take a charge for that, and they expect that to be much less this year. So $1.7 billion losing from the EV program. They'll lose some probably in 2024, but not as much, so investors like that. And then there was a strike. That took $1.1 billion out of profits, and they're not gonna have another strike again because they've got a labor contract. So you add all those things back in there, and the profits this year, they're talking about $12 billion at least in earnings before interest and taxes, and maybe as much as $14 billion. That gets up close to record profits of 2022. So all of this says profits are gonna grow versus 2023, getting back to the really good times they had 2 years ago. And they're spending less on some of these trouble spots. And also they say they're gonna start getting EVs produced, which has been a big problem for them. So some momentum.
David, I love this line in your story. While it struggles to build electric vehicles that are a keystone of Mary Barra's long-term growth plan, and its Cruise robotaxi unit is on full reboot, GM's core business of making gasoline-powered trucks and SUVs thrown off a lot of cash. All right, so there are the contrasting sides of General Motors. Which side should investors focus on at this point?
Right now, I think they're looking at the internal combustion side of the business, which is throwing off a lot of cash. Because look, it's the cash generation power of that business that allowed GM to raise the dividend and buy back $10 billion in shares. So right now, even though GM, you listen to Mary Barra today, still positioning the company as one with a technology story, one with a growth story going forward, for the next 5 or 10 years with these electric vehicles, with Cruise. Investors are focusing less on that because they see GM as a company that's returning cash. And if the forecast says they're going to do well enough to continue to do that, then investors are going to buy in.
I mean, David, this seems to be the theme of 2024, which is stepping back from the idea of everyone switching to EVs quickly, which people really got wrong over the last couple of years, and many companies really got wrong, and saying that the transition is going to be a lot longer. I mean, look what's happening with Ford, look what's happening with Tesla. Does it seem to you that the company is indeed not putting these on the back burner, but tamping back investment in a way that other companies are too?
Well, with GM, a lot of the investment in that EV program has already been made. You look at the vehicles that they're bringing out this year and the ones where they're trying to ramp up production. It's the Cadillac Lyriq, it's the Chevy Silverado EV, the Chevy Blazer SUV, and the small Chevy Equinox Compact. They still have the Hummer that they're ramping up. They already spent the money developing those, so that's money spent. Where they're saving money is delaying programs like the Chevy Silverado EV. There's a plant in suburban Detroit that's going to ramp up production of that. They're delaying that by a year. So they have delayed some of the investment, and that does save them some cash this year. But it's not a huge amount. I think really the EV story is there's still growth out there. It's just not what everybody thought it was. So everyone is in a watch and see mode with that. But they are pulling back some investment, and that allows them to maybe return money to shareholders, maybe freshen up some of the internal combustion vehicles that are making some more money for them.
All right, so maybe, pulling off a little bit of the EVs, but still, that's part of their core mission longer term, and focusing on kind of what consumers want today. Isn't that what GM and Mary Barra should be doing as the head of a company, and just kind of adjusting to the environment, maybe keeping those long-term goals in place? David, how do you see it as somebody who follows this industry? Is this her just kind of managing for where we are today in this auto cycle?
Yeah, and it's absolutely what they should be doing, because you can't go and just keep building factories to make EV batteries or add more EV production if the buyers aren't there. Right? So I think the real story will be over the course of 2024 and 2025 when you see some of their EVs come out, like the Chevy Blazer, Chevy Equinox, and the Silverado pickup, which will compete with the F-150 Lightning. How many of those do they sell? How quickly can they get production ramped up? And if the volumes are there, if consumers really want them, they can continue to add production. If not, then they won't. And then they've got other decisions to make. For example, they're bringing out a new Chevy Equinox. I'm talking about the gasoline-powered version next month. And do they continue to freshen some of these vehicles that they thought may have gone away in the middle of next decade? My bet is that they absolutely will, because it is going to take a lot longer than everyone thought to do this. There's another wild card here, which is that the federal tax credits, the $7,500, not as many vehicles qualify for that, but more vehicles will qualify for it. And that's just starting. And it's a new way of distributing the incentive. You get it at the dealership instead of having to file for it in your taxes. So that's real money in the showroom for EV buyers. That could have an impact. We're just not seeing it quite yet. And we need to see how that plays out this year, and whether or not it really gins up some demand and makes everybody think that, okay, maybe there still is a lot of growth from the tax benefits to be had.
You mentioned Cruise. I want to go back to Cruise, the autonomous driving platform for GM. What is the future of Cruise, especially in the wake of the incident that it had early in the past few months?
This is a really tough one. So look, this year, had all that not happened, and they not had some of these technological problems and even worse regulatory problems, they were going to try to deploy a robotaxi service in 12 cities. That's probably not going to happen. They've grounded all of that, and they laid off all the people who are doing the development work. I think kind of near term, they'll probably go back to one city, if that works well, maybe two, and they will slowly ramp up the robotaxi business, very slowly, I think. The second thing they'll probably do is really continue to develop that, because GM does see a real future in selling personally owned self-driving vehicles. And consumers do like these things like GM Super Cruise, Tesla Autopilot, where they can drive hands-free on the road, and they would probably like a vehicle that completely drives itself a lot too, and they'd probably pay good money for it. But that's a ways away, but GM will keep developing that technology for that reason, and they'll kind of see how robotaxi goes, if consumers want it and if they can make money off of the business.
Hey, real quickly, before we go, 30 seconds here, David, same thing, some of the issues that GM is seeing here in the U.S., same thing in terms of overseas, or is there any distinction, just quickly?
In China, EV sales continue to grow fast because the government practically mandates it. Similar thing in Europe, you're seeing better growth there. The U.S. is the laggard when it comes to consumers not buying EVs.
All right. So appreciate you weighing in on General Motors. David, thank you so much. Detroit Bureau is where we find our own Detroit Bureau Chief, David Welch, on this Tuesday, joining us on Zoom. Shares of General Motors, Tim, still up about 8.5%, up 10% at their highs today, but still holding on to most of their gains.
I mean, if there's one theme that sort of defines the transition from automakers from last year to this year, or from late 2022 to 2023, it's the EV transition is taking so much longer than pretty much everybody thought it would.
Yeah, well, I think there was a lot of enthusiasm. I think those government credits certainly help, and prices coming down via Tesla. But I feel like there was a period where I just saw them everywhere. But it's interesting, the numbers are telling a different story.
They're expensive.
They're expensive. That's definitely holding people back.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Speaking of that Fed meeting, Bloomberg Economics, they've got their Fed Speak Index.
This is really cool.
Right? They look at natural language, or they've got, I should say, a natural language processing model. It is trained on more than 60,000 Fed headlines, and it suggests that the first rate cut will come in May. That's later than markets' bets of March, but earlier than the second half of 2024, which we've heard from by a lot of folks, also as flagged in December's summary of economic projections.
All of this is top of mind as the Fed kicked off a two-day meeting with the first Fed decision of the year expected tomorrow. So for our interview this afternoon, we bring in Brad Case, former economist at Fannie Mae and the Fed. Brad, also chief economist at Middleburg Communities, which buys and builds rental housing in the southeastern and mid-Atlantic U.S. Brad is here in the Bloomberg studio.
And then out there on Zoom from Cape Canaveral, Florida, back with us is Steve Skanke, chief economic advisor at Keel Point. He is also a former U.S. Treasury and White House National Security Council staff member. Brad and Steve, welcome. The data by and large continues to come in okay, if not better than okay. Consumers are still confident in spending. Brad, to you first. Is it crazy for many of us to continue to talk about a Fed rate cut when you see things kind of humming along?
Yes, I think it's pretty crazy to think about a rate cut tomorrow. I think what you were saying about maybe it's happening in May and not even March, I think that's pretty realistic. Look, the Fed is looking for things to come into balance so that we don't have inflationary pressures pushing inflation back up. They want to make sure that it's dead for the time being. They don't want a recession to kill it. They want a soft landing to kill it. They're close to that, but they want
a soft landing to kill it?
They want a soft landing to mean that inflation is not going to come back, not going to come out of the grave. And they're pretty close to that, but they're not. The data continue to come in a little bit too strong.
At what point, Brad, could the Fed say mission accomplished? What does the Fed need to see in terms of data in order to do that?
Well, so we've just seen too much over demand throughout the economy. It's strong wage growth, it's strong income growth that drives strong consumption. It's demand relative to supply in the labor markets. So they just need balance sort of throughout the economy to make sure that they're not going to pull a late 70s, early 80s mistake.
Hey, on the flip side of all of this, the concept of real rates, I'm kind of obsessed. I was bothering Michael McKee in a big way today, which is when you take into account inflation. So, Steve, let me bring you into this. Even though the Fed's main rate has stayed the same since last July, as inflation comes down, the real rate of inflation has actually gone up, continuing to put pressure on the U.S. economy. How closely do you watch that as an indication of why and when the Fed will need to ultimately cut rates, and maybe while it could happen sooner rather than later?
Well, it's an important rate and data point to watch, and it'll be interesting to see how attentive the Fed is to that. With a run rate of core PCE inflation right now at about 2%, last 6 months annualizes at 1.9, last 3 months annualizes at 1.5%. The real rate of interest is in the neighborhood of 3 to 3.25%, which is double or even triple what you would normally expect. And so the Fed is not unaware that this is a monetary constraint on the economy. And the question is, can they be confident that inflation is dead or is vanquished before they let up on the brakes? And they're paying attention to that. Certainly, we're paying attention to that, too.
Steve, I'm going to kind of send a similar question over to you. I mean, what would it take for the Fed to say, for you to say that you're confident inflation is back to 2% consistently, and we're not going to see a mistake of the 70s or 80s?
Well, it's not just the 70s and 80s, Tim. The Fed got burned in 2021 with their declaration that it was transitory and it was going to be okay, and they got head faked, and along came inflation in a way that they had really not expected. They were embarrassed, and they don't want that to happen again. So I think it's fair to say that it's pretty much finished. the Fed gets a pass on the January meeting, even though arguably they could or should start cutting now, but they don't have to do anything now. And as a result, they get to see January labor information, productivity.
Right.
We get this to see all of the things that are coming next before they meet again in mid-March. And that really ought to give them confidence that it's vanquished or not. I think there's a big opportunity for them to start cutting in March, but the rhetoric tomorrow is going to be very much the forward guidance of we're not ready to do that yet. We want to see that it's finished.
But one thing
that's our job.
Let me jump in for a moment, Steve, because one of the things I'm obsessed, my whole team knows this, listening to Surveillance this morning on radio, and they had on Nadia Lavelle, senior U.S. equity strategist over at UBS Financial Services, and she talked about the nearly $1 trillion that is still on consumers' balance sheet. And she said everything is contingent in terms of the U.S. economy and what consumers do. And what she said, fair amount of that excess savings, nearly $1 trillion, with a $50 billion or so burn rate, gives a healthy cushion for a year plus that should provide momentum and support for earnings. So Brad, come back in on this. How much the Fed is watching the consumer balance sheet, even though we continually talk with folks who talk about stress on that balance sheet, nonetheless for her to come in and say that there's still room to spend. Does the Fed have to be careful about pulling off too quickly and for kind of consumers to be off and running again?
Yeah, absolutely. I think she's exactly right. Consumer balance sheets. Yeah, we've heard about increases in delinquency rates, and that's all true. But the truth is that consumer balance sheets are still pretty strong, and so the Fed will look for signs that consumption has started to falter. The most likely thing that comes first is that employment growth starts to falter. So you look for early warnings, but really what determines whether they can really pull off on the brakes is when consumption stops being so strong going forward, and we're just not there yet. The consumer keeps on surprising us.
Well, and let's bring Steve. How do you make sense of the strength in the consumer? And when you might anticipate that starts to slow down, or do you at all?
Well, I think it will slow down. We've been seeing average hourly earnings at 4%, which is above the rate of inflation. Some of that is catch up to what we've experienced in higher prices, even though the rate of inflation has come down significantly. But consumers are spending. They're doing it on their credit cards. Delinquencies are increased. I think the excess savings on balance sheets is not so evenly distributed. So I don't know how much of that will continue to power it going forward.
That's a good point.
But for right now, and we saw consumer confidence up 28% with the January numbers. That tells us that consumers feel good about what's happening in the economy right now.
Hey, Brad, you were an economist at Fannie Mae and at the Fed. So I want to hear from you if there's anything out there in the environment that you see that concerns you, that isn't getting a lot of attention right now.
Well, I think what most concerns me are things that do get a lot of attention. The stock market is certainly overvalued. And so I don't want to call a stock market decline, but that's maybe the biggest risk going forward. But the other big risk that gets a lot of attention is the fact that house prices are so high. So if consumers start to feel stretched in terms of their balance sheets, I think what you're going to see is that they're not going to be willing to buy a house at these astronomical prices.
I don't see that ever shifting. I know that was a dangerous thing to say pre-2008.
Exactly.
What would shift? The demographics show right now that there is a serious lack of housing. And this is something that Powell has talked about over the last couple of years.
Right?
This is not a new problem by any means. I don't see how it gets solved.
I think actually my company is trying to solve that with build to rent communities, because it has always been that if you wanted four walls, you had to buy them. Yeah. We're providing a different product, and that provides an outlet for some of that demand.
Well, yeah, it's interesting. We did get a data point today that U.S. home growth, U.S. home price growth slowing as those high mortgage rates are squeezing demand.
But look what we heard from the Whirlpool CEO yesterday. Concerned that people aren't going to be buying those big ticket items anymore in the near future, at least.
Right. So that's significant. But again, like, I guess what I'm trying to figure out, Steve, and I think, Tim, you and I talk about this all the time, is are we just getting back to normal? All of the unprecedented stimulus and all of the moves and measures, if you will, the impact on the supply chain, everything that went on during the pandemic, post-pandemic, are we finally getting companies and everything kind of back to normal, kind of pre-pandemic, if you will?
Well, it certainly feels like we are. If you just look across the economy, things do look pretty much back to normal. The most unsettling thing is that things actually look very, very good when you look across the economy. Yes, there are the things that we've been talking about in housing and home ownership and some of the inconsistencies in the distribution of jobs and wage growth. But by and large, things look very much back to normal. Earnings seem to be having a bigger impact on stock market performance than what folks think the Fed is going to do. I think it'll be really interesting to see if when the Fed starts cutting, the economy continues to be as generally robust as it is with positive economic growth and how markets react to that. Historically, they've reacted very well, even when they were fairly priced already.
Hey, Brad, to that point, a viewer actually getting in touch asking about negative payrolls and if you start to see negative payrolls on the horizon.
Yeah, I don't see when that's going to happen or what's going to trigger that. As we get closer to normal, you will see payrolls getting closer to zero, and that's a good thing. I mean, we just can't continue with this kind of excess demand throughout the economy that we've had for a few years now. But that doesn't mean we're going to go to negative payroll growth. I'll give you an example. We, in the rental housing space, we were expecting rent growth to become markedly negative. It didn't. Why didn't it? Because there was more demand for housing than we expected there to be. And where that's coming from is people moving out from their parents' basement, moving out from their fraternity brothers' shared apartment and getting their own place. There is a lot of room for that to run. But
is it also the regions you play in, just staying with it, because you guys are building and buying in the southeastern part of the U.S. and mid-Atlantic. You're in a hot, I have a lot of family members that have moved to like the Carolinas. Is that because of the region you're in specifically?
No, the migration story has been there for more than 20 years already. And that will continue. So yes, but the main thing that's happening is an increase in the number of people who are moving out and signing their own leases. That's what we call new household formation. That's what is still likely to run for several years now and provide this backwind, favorable wind for housing demand for years.
One last thing, hey, to you, Steve, as we listen to Jay Powell tomorrow, it really is the tone, the tenor, the message that he tries to get across. What's the most important thing? And only have about 20, 25 seconds.
How much he prepositions for the Fed not to be cutting in March. If he's somewhat neutral about that, I think that's really positive. If he's really harsh, they're really trying to buy more time because of something that they're uneasy about.
All right. Well, we will all certainly be watching, listening, parsing every word that he says. Gentlemen, thank you so much. Dr. Steve Skanke, Chief Economic Advisor over at Keelpoint, former U.S. Treasury and White House National Security Council staff member, joining us on Zoom out there in Florida. And Brad Case, thanks for coming in studio. Really appreciate it.
My pleasure.
Brad Case is Chief Economist, Middleburg Communities, former economist at Fannie Mae, and of course, the Federal Reserve Board.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, for all of you keeping check, still one day left in January for those making New Year resolutions. And while many challenge themselves to a dry January, is anyone up for a digital detox? This is something you and I have talked about before. Yes, this means actually putting down your smartphone for 1 month.
Okay, so it's an interesting challenge.
Yes.
The folks over at Siggy's Yogurt are trying to do it, and we wanted to know more and how it relates to the business and also about the business. So we got back with us on Bloomberg Businessweek, the chairman and founder of Siggi's Yogurt, Siggi Hilmarsson, here in the Bloomberg studio. Siggi, good to see you again. Let's talk about this digital detox, because I think Carol and I, we love the idea of spending less time on our phones. But the actual challenge that you guys are putting up is a month away from your smartphone, and in its place, you're going to send what's called a dumb phone.
Flip phone.
A flip phone.
Where did this idea come from?
Well, I think the idea is sort of, connected a little bit to the brand in a way. So our sort of philosophy when I started the business like many moons ago was to strip away all the stuff that we saw in yogurt, which is like a lot of ingredients. So like our sort of tagline was simple ingredients, right? And we see a lot of that today in people's behavior with their phone. They sort of are addicted to it, and a lot of it is maybe not stuff that's useful. It's like very hard to be without your maps, for example, when you're navigating a new city. But do you ever get an itch to look up maps, right? But you do get an itch to check stuff that sort of you don't necessarily need in the moment. So I think the sort of idea and how it's connected to the brand is sort of to strip away the sort of the non-essentials of what you don't need in your life right now, and sort of putting away the phone for a while and see how you do is one of those things.
Well, part of us loves it. Part of us is terrified.
I'm dreaming about doing that.
We want to continue with this, but we also want to mention a headline crossing. PayPal Holdings is going to reduce its workforce by about 9% this year, as the company's CEO, Alex Chriss, who took over, you might recall, in September, is grappling with rising competition, profit pressures, and a raft of analyst downgrades. So again, cutting around 2,500 jobs. Just taking a quick check on the stock, and we're seeing PayPal shares still up on the day, just shy of 1%, but off its highs. So going back to, we're talking with the chairman and founder of Siggi's Yogurt, Siggi Hilmarsson. So you're talking about this digital detox, and I think it's kind of interesting, this idea, almost an attractiveness towards simpler times.
I didn't mention the $10,000, by the way.
No, and right, there is a competition.
Yeah.
A little bit of an incentive.
Yeah,
right?
Pretty good incentive. Not just free yogurt.
Not just free. Well, there's a little bit of free yogurt as well.
But
there's
not
a 3-month
just free.
supply of free yogurt too. But $10,000 free yogurt,
it catches people's attention. And I think, what's interesting, it's stuff like this that makes us kind of think about our environment right now. And we talk so much about the role of technology and how it consumes us. We're also kind of using technology as a great, kind of clues, sometimes data collection gives us an idea of kind of what the environment is like. And I want to just go there if we can for a moment, just coming off that headline. How do you see the business environment right now? How does it feel to you?
Well, at least for Siggi's, we've been doing great in the last few quarters. Business is up like a little close to 3 times the categories, like around 6%. Categories up around 2%. So business is doing pretty well for us. We sort of see still a strong interest in our offering. We see a lot of the sort of hiccups that we went through, like everybody in COVID, fading out, like supply chain issues, on anything from freight to cardboard was a huge issue during the pandemic. We also saw some of the sort of changes in the consumer settle that, like for example, the desire. We had a lot of single serve business, and we saw that graduate a little bit more to like family sizes during
people
COVID,
aren't going out,
as people are not sort of on the go, going to the office. Obviously, that has since picked up a little bit because of office openings again.
What about raw materials costs? Not cardboard, not containers, but dairy. I mean, we're off of the highs from COVID when it comes to dairy prices, but they're still elevated.
Yeah, there's still some of those cost pressures are not going to go down, but we see a lot more sort of more balanced environment.
Well, and it's interesting, too, in terms of your environment, and we talk about the first time we talked, you guys had just been acquired. This was back in, I think, 2018.
Correct.
The French dairy giant, Lactalis, I think I'm hopefully saying it correctly.
Good memory.
But I'm just curious, as your business, which you began back in a New York City kitchen back in 2005, how it evolves, grows, what kind of, stands out for you in terms of that process and how the market changes, consumer demands changed? What's changed?
Well, the biggest thing that obviously changed for Siggi's since the acquisition was, we're now international, which is a lot of fun. So Siggi's is not just a U.S. brand. It's doing phenomenally in France. The sales team there has done an amazing job, and Canada, Australia as well. So that sort of stands out for me personally. But in terms of what stands out, like the market as a whole, is that when I started, yogurt in America had crazy amount of sugar, right? Like the best-selling yogurt at the time when I started had 28 grams of sugar per cup. That doesn't really almost exist anymore. So everybody has come down. So for us, that's obviously great because we sort of feel like we moved the needle a little bit on the market.
But it's more competition.
But it's more competition. So it's sort of like a blessing in disguise a little bit. But we are still the only one that sort of offers what I call the complete package, which is that lower sugar, clean ingredients, and higher protein and better texture. So there's a lot of people who sort of copy one element of our strategy, but nobody who offers this sort of trifecta of all the things that are good for you, I think.
How are you thinking about brand innovation in a category that has, as Carol mentioned, no shortage of competition? Like, where's the white space right now for you?
Well, we think like the drinkable yogurt space is pretty exciting. So we're coming out with some new innovation there in the coming months and years or quarters. Maybe that's like, since we're here, we should say quarters. But so I think that's pretty exciting. And we're revamping some of our older drinkable yogurts that have been doing well and been on the market for a while. So we see interest there. But you are right, the competition is pretty fierce.
I think it's interesting too, because, we talk about whether it's becoming more sustainable, making that so that works with the cost side of the equation. But what you talked about, how in terms of yogurt, it's really shifted in terms of ingredients, becoming much more healthy. Do you feel like increasingly consumers, we talk about it, it's certainly a priority for me. I know it's a priority for your family. It's obviously a priority for you and your company. But you increasingly see consumers demanding, they're turning it around, checking the ingredients. They want cleaner products.
100%. I mean, there's like a day and night when I moved here, and when I started the company about 15 years ago, is that people are so much more savvy. And not only do they do what you say, they look at their ingredients. They know even some of the more esoteric ingredients that people use. So, that's sort of still our claim to fame. We're one of the few brands that only uses, for example, just fruit. We don't use flavorings. So people notice that kind of stuff.
Okay, 10 seconds. Is there another thing from Iceland that you could bring to the U.S. that you think would be successful?
Well, I think the dried fish is delicious, but I don't.
You're not talking about the buried shark that ferments underground, are you?
No.
Because that is not delicious.
That is still quite moist, but I love the dried fish. I eat a lot of the dried fish when I go home. I love it with a little bit of butter.
Is that the next company?
Sorry, I don't know. I think that might be a tough sell for Americans.
We got to run. Good luck with the contest. Siggy Hilmarsson, of course, chairman and founder of Siggy's Yogurt, right here on Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, everybody. Well, all right, got a great take on UPS, but we want to talk about what's going on with the consumer. It's kind of all connected because when we buy things, somebody's got to get it to us. But one thing we keep wondering about, we talked about this earlier in our Fed discussion, is about the strength of the consumer and consumer confidence. We saw increase in January to the highest level since the end of 2021 as Americans grew more upbeat about the economy and the job market. That was the data point today. We've got a great voice on this.
Okay, let's bring in Alex Gailey, senior data analyst at Bankrate. She joins us here in the Bloomberg Interactive Brokers studio. Alex, we wanted to talk to you because you guys have a new survey out that kind of throws a little bit of water on all the positive data points that we've gotten about the American consumer. It's about savings. Talk to us a little bit about what you found.
Yeah, so we did see some positive consumer data come out today, and that looked great. But our own data at Bankrate actually found that over half of American workers say it's either difficult or impossible to consistently save enough money to feel comfortable for retirement, emergencies, or really any other reason given their current situation. And so we are also seeing additional data at Bankrate that shows that less than half of Americans can afford an emergency expense of $1,000 or more from their savings. And so although the consumer may feel generally confident right now, they are still struggling with their savings, and we are still seeing inflation play into, affect their budgets essentially.
We've got a great chart for everybody who's watching on YouTube and Bloomberg Originals. And in terms of your survey, and you looked, I think this was December 18th through the 20th, right, of 2023, and about 28% find it somewhat difficult in terms of saving for emergencies. You've got 32% someone easy. When you look at this breakdown, How does it compare to the trend line? I'm always interested in like kind of trend lines. Are we building momentum to a different story or a significant story? Are we, in your view, as you guys look at these data points, building towards something where you can kind of definitively say the consumer is starting to fall apart? Because other data points say differently.
Yeah, there's a lot of mixed research out there. In our research at Bankrate, we do track this year over year, and when it comes to retirement savings and emergency funds, we haven't really seen progress on that front in the last 2 years.
Is it the same?
It's very similar, yes,
Okay.
which I guess you could say that's not necessarily bad news, but it's not good news either, because we would hope that we would be seeing progress on that front of emergency savings and retirement savings.
What was it like 5 years ago?
I
Like,
think-
is this kind of like what we tend to see, though, in terms of the breakdown, or a few years ago?
Well, it really depends on what's happening in the economy at that time. So right before the pandemic, you were seeing overall a stronger consumer, job market was doing well, things were going well, and then boom, the pandemic happened. And
So
then,
this isn't the kind of chart we just showed everybody you would have gotten pre-pandemic.
no.
Yeah, so people would have felt like, okay, we're in good positions.
Yeah,
Okay.
absolutely.
Okay, so you talk a little about in your report what people should be doing and the way they can sort of incrementally improve their position. And it has a lot to do with different types of psychology and like thinking about saving differently. What do you guys find at Bankrate?
Yeah, so we find at Bankrate that starting small is really the most effective way to build up your savings, because we often hear financial experts say you need 3 to 6 months worth of expenses. That is thousands of dollars for most Americans, and that's a very overwhelming
We had
figure.
a guest on last week, Jared Dillian, who wrote a new book about. Yeah, and he says you should have a couple of years of cash on hand.
Well, yeah, I mean, it really comes down
We
to
also
your
said
own.
you should have a spreadsheet with your wife or your husband or your partner
Yeah.
in terms of home ownership, but go ahead.
It's an unconventional book, let's just say that.
Right. I mean, it comes down to your personal finances, but ultimately 3 to 6 months worth of expenses can feel very overwhelming. And so we recommend that you start small, $5 a week, $20 a month. That's $500 in 2 years. That's $1,300 in 5 years. That's $3,000 in 10 years. And although that may seem like small amounts, the momentum that you'll get there, you'll start to really feel the motivation and keep adding to your savings.
Alex, is there something that you guys over at Bankrate, and this maybe goes away from this survey, but just generally in your discussions, when you look at data points, and here we are, 3 years out of the pandemic?
Yeah, I mean, we're getting to the point where we're a 4-year anniversary.
4-year
basically, of
anniversary. I'm trying to
lockdowns.
remember where we are. Like where you say, I know that data points look good, but here's what we're hearing, or here's what we're seeing that we're getting a little worried, or you're not there yet.
On what specifically?
In terms of concerns about the consumer, that maybe the data isn't just showing everything.
Yeah, I mean, data isn't perfect, right? It's something that we use to help us inform us on what's happening with the consumer. But overall, I think the picture right now is that, the consumer is feeling the pressure of inflation still. Inflation is still well above the Fed's 2% target rate. Those higher prices are still squeezing household budgets.
They're still going up, just not as much.
Absolutely. And at the same time, we have rising interest rates right now. And we do see that Americans are increasingly turning to credit cards right now to pay for things. Our research at Bankrate found that 49% of credit card holders are carrying a balance month to month. That is up from 39% in 2021. So you are seeing that debt really rise across American households. And that debt is very expensive to carry month to month right now. Those high borrowing costs are likely impacting Americans' ability to save right now as well. So there are a lot of economic factors at play: inflation, rising interest rates. Wages have not been keeping up with inflation and have not caught up yet. And at the same time, you have all this at play, and it is affecting Americans.
That's interesting that the credit card balances. Like, I feel like we keep.
And some
stuff
stuff
about
is
that.
still rising double digits. Car insurance. We talked about that.
I'm not going to get you started on
Okay,
that.
don't get me started. But
I meant to talk to you about that.
okay.
On air.
Oh, did you look at your car insurance? Okay.
Not so bad, though.
Okay, that's good.
Alex Gailey, thank you so much. Some great insight in terms of the consumer. Senior data analyst over at Bankrate, joining us here in our Bloomberg Interactive Brokers studio.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody. So we just heard, obviously, from Microsoft and Alphabet. We talk about the shares. We've got Alphabet down about 4.5% here in the aftermarket. We've got Microsoft down about 1.3%. So let's get to it and do a little bit of a roundup for you. With us right now is David Kirkpatrick. He is founder and editor-in-chief of Techonomy. It's a media and conference company that focuses on technology. He's familiar, certainly, to our audience, and he joins us on Zoom in San Francisco. Also with us is Mandeep Singh, senior tech industry analyst for Bloomberg Intelligence, joining us right here in studio. Mandeep, I want to turn to you right now. And Alphabet down 4.4%. What's the important part of what they just released? A lot of kind of data points, if you will.
Yeah, search had a slight miss when you look at the top line number, but it was sort of expected, given everyone was talking about how the competition from ChatGPT will have an impact on the volume. And I feel on the cost side, there are puts and takes. Clearly, they have brought down the cost through the layoffs. But when you look at the cloud numbers, that have actually done better than expected. So what the Gen AI workloads are doing is boosting the profitability of the cloud. But the core search business remains under pressure. And that's why you're seeing that reaction.
But is it under pressure from ChatGPT? I mean, are people using ChatGPT the way that they use Google search? I mean, ChatGPT is... It doesn't provide the same service as Google search.
It doesn't, but think of the volume growth, right? So for search business to grow double digit, you need both volume and ad pricing. We know ad pricing has been declining for the past 6 quarters, not just for Alphabet, but for everyone in the industry. So you need that volume growth. And I feel in this case, you're not seeing that volume growth because it's not just ChatGPT. There are other competitors that are building on top of that GPT stack and really trying to disrupt search here. Amazon and TikTok, they were doing it, but now there is even more competition on the search
in the ad business, so important to Alphabet. David Kirkpatrick, come on in on this. Your reaction, first of all, with Alphabet.
Well, I love listening to Mandeep, by the way. I would say, it's interesting, both companies, Microsoft and Alphabet, the CEO's statements are raving about going into the AI age. And yet I don't think in either case, certainly in Alphabet's case, we are yet really seeing that much impact on revenue and profit from AI. That's still to be seen. But they have done a pretty good job recouping from the perception of having been really way behind the 8 ball on AI. The economy is helping also quite a bit right now, much better than we might have feared it would be. So I think both companies are surprisingly impressive right now in their results.
Yeah, David, I'm really glad you said that.
They were overbought. So, people have been buying these stocks like crazy in recent months. And I think a little bit of decline doesn't mean anything for the long term.
I'm really glad you said that about the investments in AI not necessarily showing up in the top and the bottom line. And I mentioned that just before Starbucks earnings crossed when we were with our simulcast with our colleagues on Bloomberg TV, because it does seem like it's improved the product a lot. And I've had people talk to me about PowerPoint and just how easy PowerPoint is. Because AI actually makes it so much easier to build these slides. Like, it saves so much time. But does that sell more PowerPoint? Does it sell more Microsoft Office suite when the market is already pretty saturated with that?
Well, it will sell more PowerPoint over time. I don't think we've seen that yet. I mean, what actually I think will happen is we're going to see a leveling of all tech products that are all going to have AI infused into them. And the people that will lose are the ones who don't infuse AI into their products. Now, Microsoft is a little bit ahead of the curve because they have this great partnership with OpenAI. But I mean, everybody's going to be doing it. And we might even not notice it in a year or two because we're just going to expect it.
All right, so let's flip to the other big report that we got was Microsoft. Right now, the shares are pretty much little changed here in the aftermarket. They were only slightly lower. Revenue topping estimates, cloud growth disappointing some. Second quarter cloud revenue was 33.7. The estimate was for 32.21. Revenue overall was a little bit better. What do we need to know? What jumps out for you when it comes to Microsoft specifically?
Are you asking me?
Yeah. Oh, I'm sorry. Yes, David.
Yes. Well, I mean, Microsoft is the great execution engine of the technology industry, is my basic observation. A $3 trillion company with $220 billion in revenues, growing at 16% roughly annually. I mean, these guys are just executing superbly. And, I think that their partnership with OpenAI really has proven to be one of the most brilliant marketing efforts in technology's history, whether or not it does have any concrete short-term profit and revenue implications. I think Satya Nadella is probably the greatest CEO in global business right now.
Why do you say that?
I just think that he is managing to take that company at its vast scale, unprecedented scale, and continue to point it toward the future in a way that is incredibly intelligent. Cloud is the future of business. AI-infused cloud is the future of business. They are brilliantly positioned. It wasn't that long ago that Amazon essentially overwhelmingly dominated cloud. And now we have to talk about Amazon and Microsoft, and even Google is creeping up, Alphabet creeping up there. But I think also another amazing thing, you look, there's hearings tomorrow morning for the social media companies. Microsoft has done an astonishing job keeping itself out of controversy for the most part. They had the controversy around buying Activision. They got through it. They bought the company. These people are not being held back.
Yeah, it's interesting. And they really, has definitely kind of navigate as the market continues to change. I just want to, forgive me, David, I just want to take another look at what Microsoft is doing here in the aftermarket. They're now up 1.3%. So the investors have, at least the investor sentiment, which wasn't that dour right after the release, but the stock was a little bit lower. Now we're actually seeing Microsoft pop up about 1.2%. Back to Alphabet, if I may, which has been down about 4% in the aftermarket. Still down about 3.7%. So let's go to the analyst call. Number one question that you would put to the team over at Alphabet on the analyst call, what you would ask Sundar Pichai.
Well, I think the key question to ask is, when will you see revenue improvements because of AI? Okay, you've got Gemini. You've come through this challenging period where people said you didn't get it. Now you apparently have gotten it, but does it matter? That's the key question, I would say, if I were an investor, especially buying at these valuation levels, because they have to show something dramatic going forward to justify their value.
Hey, listen, I just want to mention too, AMD just crossing. Why do we care? This is one of the best performing stocks in the S&P 500 once again in the great chip race, if you will. What I'm going to go right to is the outlook for first quarter revenue, $5.1 billion to $5.7 billion. The estimate was for $5.77 billion. So that certainly feels a little bit light. What's the stock doing in the aftermarket?
Yeah, the stock is moving AMD down about 2.2% in the after hours, but there was a big trade earlier that took it down significantly, so bouncing around.
Yeah, it also is talking about the first quarter adjusted gross margin, about 52%. The estimate was 51.8%. So the gross margin there, the adjusted gross margin, certainly better. And expecting data center segment revenue to be flat sequentially. AMD says positioning for, quote, strong product ramp in 2024. Hey, David.
I think the concern is this first quarter revenue guidance that really came in on the
right side.
Yeah,
it's
really
quite a range.
light. I mean, yeah.
It's a range.
Well, 5.1 to 5.7 when estimates were for 5.77 billion. I mean, shares dropped 4%, Carol, right when that number came out.
It's still down about 3%.
Okay.
Hey, David, just got about 30 seconds here, or 25 seconds. Any thoughts about the great chip race that's underway, it feels like?
Well, I certainly don't write AMD out. I mean, they are not NVIDIA, but they are as close to NVIDIA as any company right now. Although from what I hear, even Intel is coming up with some interesting improvements that might help them in the AI universe, which is just again, defining everything. Everything has to be seen through the lens of the AI battle now. I've seen AMD go from the most beleaguered company when I used to be at Fortune back in the day to a company that really is of great, exciting interest to all of us for good reason.
It's fascinating. Hey, David, thanks. It's been fast and furious, but we really appreciate it. David Kirkpatrick is founder and editor-in-chief of Techonomy.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, less than 18 minutes left in today's trading session, getting ready to wrap up the Tuesday trade. Charlie just breaking down some of the equity numbers. Dow still in the green, if you will, just up slightly, a little bit lower on the NASDAQ, just down about 0.7%, but the S&P, call it flat right now.
Everyone's just waiting
For the Fed decision.
Waiting for earnings, too.
That, too.
Yeah, there's a lot. There's a lot. Hey, speaking of earnings, our next guest says most of the return this year has come from 5 large tech stocks. And they're in the midst of reporting. 2 of them, Microsoft and Alphabet, are happening after the bell today. He says, Carol, those 5 large tech stocks earnings will be market moving.
Right. We've already heard from some of them. So let's get to it with Sandy Villery, portfolio manager at Villery & Co. on Zoom from New Orleans. The Villery Equity Fund, little change this year, fractionally on a percentage basis. Sandy, good to have you back here on Bloomberg. Let's go to those 5 large tech stocks that have been so important when it comes to momentum moves, certainly in the trade last year, even though we've seen a broadening out, and we continue to keep a real close watch on this year. What have you learned from what we've gotten so far, and how much are you watching Microsoft and Alphabet when they report later today?
Yeah, I think it's extremely important. I mean, they had such a good run last year. I just think they're, pretty over, I just think it's a very overcrowded trade, and they're going to put up good numbers. The question is, will they beat all these whisper numbers out there? And then, when do people feel like finally stocks are just overvalued and there's not much more to go from here? I think the rest of the year is actually going to look a lot like it does today, where you have kind of tech a little bit weaker and maybe, some money flowing into things like financials and energy. That feels to me like the way things are going to be, really for the rest of the year.
So where are the opportunities then for the rest of the year, Sandy?
Yeah, I mean, when I look at just 20-year averages again on large cap growth, typically it's been around 18.9 times. Now we're trading around 27 times. So again, I think that's crowded. And the place we like is small cap, where the 20-year average is closer to 16.7 times, and it's 16.3 times. So I just feel like there's going to be a much better opportunity to find undervalued securities in small cap that's really been left for dead, and a good chance to sort of dig through that rubble, as opposed to jumping on with everybody else and being in that overcrowded tech trade.
Here's my problem, though. If you've got companies like an Alphabet, where they're expected to show revenue gain 12% in the fourth quarter, marking the second consecutive period of double-digit growth, the company benefiting from things like what they're doing in generative AI and adding to their portfolio there. I mean, if that's where the growth is, while these big mega cap tech companies, I think we talked about this with Gina Martin Adams, maybe not the biggest part of the economy, but obviously a big part of the market. But if this is where the growth is, don't you want to have some exposure? And then what kind of exposure do you choose for your portfolio?
Yeah, and frankly, they could be younger companies that are going to use AI to become more efficient, et cetera. I just think of I used to own a 3D printer company, and it did fine, but one of its customers, Align Technology, did so much better because they were making the Invisalign braces. And so sometimes when you use that technology, you can do a lot better than some of the NVIDIAs of the world that are creating it. So I just think a lot of those names are just priced for perfection. No doubt they're going to have incredible runs. They're incredible companies, but I just feel like they're for the short run probably on the overvalued side, especially with my sort of macro thesis that inflation is going to be a little bit more stubborn, and you may not see the kind of the 10-year fall from these levels. I think it actually gets, lifts a little bit, and that's going to be a little bit of a headwind for technology stocks that do well when rates fall.
38 to your point, in terms of weightings, I looked up VTI, which is the Vanguard Total Stock Market Index. It tracks about 3,800 different companies.
Right.
The entire U.S. stock market. Apple is 6% of that. Microsoft is 6% of that. Amazon is 3%. NVIDIA is 2.5%.
So outsized presence, no doubt about it.
Outsized presence, like, to put it lightly.
Right, exactly.
It's pretty wild.
No, I get that, but it's just interesting because I feel like, Sandy, I've been there before where people are like, got to back off these big, mega cap tech names, only to see them coming charging ahead and then also seeing them fundamentally perform. So I kind of get some of the enthusiasm.
Yeah, it's just one of those things. And I guess if you go back through history, and I can certainly remember 1997, 98, 99, and those are sort of the dot-com era. But when things fall apart, they fall apart quickly. And these are much more sound, solid businesses, et cetera. But it wasn't too long ago in 2022, of course, in the face of 11 straight rate hikes where, tech was down, 30+%. And so, you just want to be cautious. And I'm a big believer in buying individual companies at reasonable prices and trying not to overpay for things. And I just see many opportunities in smaller names.
So it's just a valuation, really, call for you. All right, so let's go to some of the names that you like. On holding, we have had one of the company's CFOs, or the CFO on, along with, I think he was also co-CEO.
Yeah, Martin Hoffman, co-CEO
right?
and CFO, we talked to recently. Just before the marathon.
I got to
did pretty well.
Fully transparent. He did. I went and bought a pair of sneakers after he was on. Like, we talked about them.
And what's the you like them?
I like them. You like them as well as a stock in your portfolio. And I think it's one of your bigger holdings. Talk to us about that play.
Yeah, I mean, it's, a Swiss, shoe company, essentially. I guess I've got about 5% that's exposed to apparel. It's really a direct to consumer story. They do have wholesale. They now have 50 retail stores. So that's, between owning and franchising. So the growth is just, too phenomenal. I mean, it's a brand that I see certainly, here, or, in Louisiana, but you see them a lot in the Southeastern Conference sort of, areas and that sort of thing. But, these guys are going to do probably 386 million Swiss francs in EBITDA this year. And then you'll see, 2025 should be more like 511 million Swiss francs. So I just think if you put a 22 multiple, when you start looking at enterprise value to EBITDA, you sort of get a $40 stock price. And that's 50% upside from here. So I think because they have, exposure to the consumer with a crazy interest rate market, people are a little bit down on them. But this is a real premium brand that I think people are going back, and they're very brand loyal, and they're buying that fourth and fifth pair. And it's a neat story with a great growth trajectory.
Okay, we got 20 seconds left, but let's hear about Palomar Holdings. It is a $1.5 billion market cap company, PLMR. Why are you optimistic there?
Yeah, I like the story a lot. Specialty insurance company, but it's cheap, right? When you start looking at the large cap tech names, this is one that they're going to earn $4.15, this year. So you're talking about a 14.3 multiple. For a very fast growing insurance company. It came out of private equity, so great technology, allows them to get super granular on their underwriting. And it's a business I think is going to work out well, especially from these low levels. It's just got a high margin of safety. So we like it as well.
Yeah, seeing the stock up almost 9% already here in 2024. All right, Sandy, good to check in with you. Sandy Villery, portfolio manager at Villery & Co., joining us on Zoom from New Orleans. Stocks bouncing around. We are seeing the Dow only in the green right now.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.